As a real estate agent, I'm often presented with, hey, I need an attorney to do estate planning. And the challenge of that question is that can mean anything from somebody died and left you a couple $100, you know what to do with it, to a more complicated transaction that requires specialization, a lot of moving parts, maybe more of a team. And I recently came across Vishal Petigara, who specializes in working with larger estates outside the exemption, but also involves more complications, more money, more assets, more complications. And so, Vishal, thank you so much for taking time with us today.
Oh, you're very welcome. I look forward to it.
So you practice in California and?
Well, no, predominantly I'm based out of New York. My practice kind of spans the whole country. Where we have to get local counsel, we do that. We also have a bit of an international component to what we do. Oftentimes, our very high net worth or ultra high net worth clients, they have a bit of a footprint overseas. And oftentimes we're able to leverage that nexus offshore in order to optimize their estate situation or their tax situation, or specifically how to optimize or structure a transaction that they're doing in order to minimize the tax effects on a going forward basis.
So you're talking about kind of planning beforehand, getting ready to do a transaction, and you can sell a business, you know, for X. And the question is, though, how much you end up with after taxes, right? And so what your goal
Right, that's correct.
Is to structure, I'm sorry, I thought your goal then is to structure the transaction in a way that the after-tax benefit is maximized, not just the sales price amount.
That's correct. That's correct. As a matter of fact, you know, one of the things I like to tell people is that they ought to have the tax situation on their mind as they're starting to negotiate the deal, right? Yeah. Because how the deal is structured often defines what the tax ramifications will be. Getting us in early on that, right, really facilitates the negotiation of that deal in order to get the best tax effect for you, right? Mm-hmm. By way of example, I've got a client who was selling their business in California, right? They were going to do an asset sale. Fortunately, we got to them before they started to get deep down into the negotiation. We were able to structure it as a stock sale. The stock was moved into a Nevada trust. The stock was sold where the stock was held. And ultimately, they were able to shave off the 9-point-some-odd% California capital gains tax from that. They effectively increased their gain by $3 million. Right now, obviously, there's a lot of moving parts in that example. And it's not as easy as I just made it sound. But long story short, the client spoke with us in advance of doing the deal. We helped them renegotiate the terms of the deal, how the deal would be structured. The purchaser, no harm, no foul to them, right? They were able to take what's called a 338H10 election to treat the stock sale as an asset sale. So no harm, no foul again. Our guy was able to treat it as a stock sale and ended up shaving off state level capital gains tax.
And that's right to the bottom line. Like whatever money you owe people and to pay off and all that, the savings on taxes is like pure profit almost in most deals. At least that's how it feels
Absolutely.
To the consumer at the end.
It boosted his return by 10%.
It's a big number. And you're talking about a big number on a big number is a really big number.
Right. It was a $30 million transaction. He shaved off $3 million on the sale. Had to pay the 20% federal capital gain tax. Did not have to pay the California.
So now in this case, you're able to work a stock sale. My experience with people like that is, in addition to the company, they usually either have other assets, real estate, residences, second homes, rental properties, corporate headquarters buildings that the businesses run out of. And they'll think about all that as assets as well, but those are also assets that need to be protected. So it seems to me like anytime you have any real estate, particularly if you're in California or New York, you should have an estate plan started and update it regularly. What's your kind of guideline? What's the minimum threshold?
Yeah, usually, you know, the most complex planning that we do, it's not a hard and fast point, right? Somebody could have a negative net worth, but hey, look, 5 years from now, if they sell their business, right, they're going to be flush with cash and, you know, assets and that kind of thing, right? So, you know, we plan for that eventuality. But, you know, I guess a rule of thumb for us is that it's worth planning for your assets right around the $5 million mark, right? And the reason I'm saying that is because even though the individual exemption is 13 plus, right? Give it time, one, you'll either be at that 13 number, or even worse, Congress decides to lower the threshold, right? Which is a very real possibility, right? The going talk of town is about 5 million is what that threshold might become.
Right.
It's not a certainty. That it's very election dependent, but it's a real possibility that the estate tax threshold could come down, making planning critical. Now, your example of a person who has multiple assets, real estate, operating business, they own an office building, et cetera, right? Typically for something like that, we might devise a family holding company structure, right? Where the family holding company is going to be owned in part by an irrevocable trust for the benefit of their family. We like to use Nevada Domestic Asset Protection Trust for that. And, moreover, the individual will continue to own 30 to 40% of the enterprise, the family holding company. The reason being, if they're relatively young, they'll still need a balance sheet in order to transact, right? And by retaining that degree of ownership, instead of shunting it 100% into the trust, right, they will continue to have a balance sheet that they can transact on. We're not trying to take away someone's ability to do business, right? We're trying to protect them as much as we can. The reason we like Nevada is because of their asset protection statutes, right? So in Nevada, they can get, any liability turns into effectively what's called a charging order, right? That charging order can tack on to, say, the family limited partnership or the family LLC interest that's owned by the person who happens to be liable. And ultimately, you end up with a situation where the family company doesn't have to make actual distributions to that person, right? But they have to issue a K-1, right?
Ooh.
So it creates a poison pill. Right. So that's the degree to which we plan, we're taking into consideration the trade-off between asset protection and estate tax, right? Over the years, say someone's in their mid to late 40s, early 50s, right? They might own 40, 50% of this family enterprise, but every single year they're going to gift, right, the annual gifting exclusion amount to their trust. Right? If they're married, they can take a split gift election and basically double that amount. The interesting part is because it's a closely held company, right? Because we can apply valuation discounts, we can optimize the percentage of interest that's being transferred on a yearly basis, right? Ultimately, hopefully 20, 30, 40 years from now, right? That person has lived a long, ripe old age. 100% of their ownership interest in that family organization will now be in the trust. Right? On paper, they're not going to have any assets that are going to be subject to the estate tax, whether it's 5 million, 13 million, or zero. Right?
Well,
One of I guess the moral of the story is asset protection and estate planning in particular, is oftentimes seen by a busy person as being something optional, something they can put off, because of the amount of time necessary to truly affect a minimization or elimination of the estate tax. Right? Give us a call, right? There's no better time than now.
well, I also see that maybe somebody can say, I don't care what happens to me after I'm gone. But in my experience, because I do more in probate, which is the failure to plan ends up being litigated in probate, on large estates, what I find is I can't believe that person was around. They wouldn't be horrified to see what they left as a mess. That simple estate planning would have resolved. Siblings fighting, children not being treated properly, everything out in the open, things being sold at fire sale. I know that nothing would upset an entrepreneur than seeing their assets sold at a fire sale price just because they didn't plan ahead. And so from where I sit, I look at estate planning more as the avoiding of probate, whereas in your case, you're really able to maximize people's after-tax benefit. I think your focus is more on business transactions and after-tax benefit. And we're just maybe on two different parts of the life cycle, but they're both
two
important.
sides of the same coin, right?
Yeah.
Ultimately, there will be a probate, right? How fast that probate moves along, how orderly it moves along, and how expensive it is are really the variables we're trying to control.
Right.
Right. So if we've shunted 100% of everything into a trust, right, the assets are clearly passing outside of probate. There could be a few items here and there, cash in a bank account, one or two personal items and that sort of thing that end up going through probate, right? But those ought to be much easier to handle, especially if there's a will, we call it a pour over will, in order to accommodate those assets, right? Family jewels, who gets the remainder of the cash in my personal checking account, yada, yada, right? One of the things that, I think people ought to know is that a critical element, why you want to avoid probate, why you should plan now instead of leave it to your relatives to pick up the pieces later, is one, like you said, the acrimony and the misconduct that might occur afterwards, right? The shame of it all. But more importantly, there's also the cost of probate, right? In your experience, what would you say the cost of probate on $100 million estate might run?
It's never ending. You can say that because you have the probate attorney, you have a fiduciary, you have witnesses, you have accountants. I'm brought in on a case where the owner was the broker of his real estate business. So they need to hire me in this case to be the broker of record. They need a property manager to manage the properties that he was, running the company of. And it just seems never ending that things are being brought in to manage the assets that this person spent their lifetime building. And like I said, he could say all he wants, I don't care what happens when I'm gone. I don't know what happens after we pass. I mean, I have a sense of it religiously, but I can't say with certainty I know what happens. But I know this, if he was watching what was happening, he'd say, you know what, I should have put a plan together before. It would have solved a lot of these issues, because nobody works that hard to build assets and wants to see them, either expenses aren't necessary or assets sold because they have to be sold. Nobody wants to see that happen.
Right. Isn't it true that the cost of probate is a fixed percentage of the taxable estate?
Well, yeah, there's extraordinary costs on top of that. So, there's a sliding scale in California we call statutory limit, 4% of the first, I think, 1,000 and 3% of the next, and it works out on $1 million estate to be $23,000, and then 1% for all assets over that point. But that's just the probate attorney, and that's just his regular and ordinary. That's the limit on their regular ordinary fees. If there's extraordinary fees, they charge that as well. And then they may need to hire a fiduciary. They might need to hire experts. They might need to hire accountants. And so all these things start to add on. So you ask a fair question. Sure, it could be $1 million. It could be $5 million easily on a estate of $100 million easily. Whereas the same estate plan upfront would be a fraction of that, I would assume.
Right. So critical to obviously estate planning, when you have a business that is a going concern, an operating company, right? An integral part of an estate plan is also business succession planning.
Right.
Right. You want to have the backup, like you said. They ended up hiring you to be the managing broker, right? If you have a law firm or something like that, there has to be like somebody who is licensed as an attorney in the state where the law firm is based in order to take on those reins. Right. Otherwise, not only do you have issues with your business as a going concern, but you're also going to have issues with your clients whose businesses are going concern, and that can create potential liability to the estate. Right. So a lot of these things kind of come together and coalesce into an optimal plan. It's not just the estate planning, it's the business succession planning as part of that, a reasonable modicum of life insurance in order to cover some of these losses and costs, as well as transition of assets that might fall outside of that estate.
Well, obviously, these are complicated issues worthy of great attention. And I think the other part that I found as a real estate agent is so many people have an attorney that they like and work with, yet may not be a specialist in that field. And that's why I was drawn to you when I first met you, and I think wanted to share you with my clients and my world, which is that this is an area that you focus in. And even an attorney who does estate planning, if this isn't your ordinary experience dealing with a large sale of a large business, bring an expert in and get the right plan put together so things fall in an orderly manner. So Vish, I really appreciate the time we spent today. If someone wanted to get more information from you, what's the best way to get in touch?
The best way to get in touch with me is either by email, which is vishal.petigara@petigaralawgroup.com, or with just by giving me a call. It's obviously country code is 1, area code is 215-527-0700. 4366. So that's 215-527-4366. And the email again is vishal.petigara@petigaralawgroup.com.
Fantastic. And we will have that in the description down below. Vishal, thank you so much for your time today. I always I learned so much when we chat, and let's do it again sometime soon.
Absolutely, Bill. Thank you so much for the opportunity.